Oh, what's going on, guys? And look at this quarantine hair. What the hell is going on? Oh, man. This is wild. Crazy times, though. How's everyone doing today? Just getting set up here, guys. Give me 1 second. We'll hop right into the trades. How's the market doing today? VIX is so low. Under 30? Wow. I think it might be a little premature for such a drop off in volatility, guys, but it looks like it's what's happening. What can I say? So yeah, we're gonna break down some trades today. I had a few trades that a few friends of mine wanted me to take a look at for them, so I'll probably start off with those. Before we get rocking and rolling here, though, I'm just gonna make my little post on StockTwits. All of our friends over there can join us here and hop on some trades with us. But yeah, today it's gonna be pretty chill, guys. I'm just gonna go through some trades, break down some ideas, have a look at like what my buddy wanted me to see for him. And then, there's obviously some options trades as well that, in the earnings space that we will probably take a look at as well. I broke down some of them yesterday as well. Guys, if you have anything that you want me to break down for you as we go through this session, feel free to just leave a comment and I'll hop right on it. So you want me to break down AMD. Premiums are looking dirt cheap. IV has been trending down lately. Sure, let's take a look. AMD. What's going on with these guys? What's up here, guys? What happened to my music? I swear I had music playing. I'll put that song back on. I like that song. Rockstar. It's pretty dope. Pretty cool beat. Okay, so AMD, let's see. What's going on here? No earnings coming up. Cool. That earnings has already passed. I think we traded that actually. So what he was saying was basically that implied volatility was coming down. The premiums were looking super cheap. And, what I'm seeing here is, so this is something that I find really interesting, right? It's like without a forecast of volatility, how are we supposed to know if premiums are cheap or not? Right. So if we look at the implied volatility 30, let's take a look. So it has been coming down. It shot down like crazy, actually. It was around 100 and now it's around 50. So it has been coming down. He's not wrong there, right? And that's something you can see in your brokerage for the most part. You can actually go and you can see how the implied volatility is moving. But the thing is what does that mean? Right? What it means is that the market thinks it's going to be moving less. But in order for us to find a trade, we got to be asking ourselves, what is our benchmark for volatility right now? Like, if I'm looking at this and I see that implied volatility is coming down, how do I know that it's not at the level it's supposed to be? It's not supposed to come down, right? How do I know if it's supposed to go back up? Well, what I would do is I would compare it to the historical volatility, which you can access in your brokerage. But where you really need to go is you need to be forecasting volatility. So what we're doing here, right, when we look at this realized volatility number, is we're actually trying to forecast the volatility into the future. Pranav, you came here for the beats, eh? Let me know how the volume is on that. Let me know if the volume is too high or too low. It's hard for me to figure it out on my end because I only know what you guys hear, or I can only hear it through my speakers. So let me know how it sounds for you. But yeah, like when I look at this AMD here, right, like, at first glance, this seems like a great buying opportunity, right? But then what you have to do is you have to overlay the realized volatility, and what you see is it's come down as well. So the historical, like actual volatility that's happened in the market has also come down. And so, okay, it's like, well, they're moving in line with each other. The first thing that we always look for when we're trying to find a trade is we try to find an edge. We try to find, something that gives us a statistical advantage in the market. And, when the realized volatility, the implied volatility, and our forecast are all in line with each other, I'm not sure I see the edge. Something that he was thinking was, that he could go out and he wanted to buy a call. It's like, okay, well, now you want to look more than just the volatility. If you're trying to find a cheap buying opportunity, you got to use the option chain to actually structure out a better trade. You can't just, buy the call, right? Then you're just buying it at the volatility. It's not, there's no edge. It's not like the volatility is cheap right now or anything. So, when I look at this, I think to myself, like, this is the common trap people fall into. They see the lowering volatility and they go, this is a good buying opportunity. This is where I want to be buying the stock. And it's like, I understand the logic, but we got to think critically about it. It's like, okay, where does our edge come from if we're doing that? Why should this work? Right? And if we can't answer that question, then, and if we can't give a good, well-reasoned answer to that question, we shouldn't be taking the trade, because all we need to do is go to a scanner of some sort. We filter by IV versus forecast, and we're going to find a million other opportunities. So he wanted one more for me to look at, and then I'm going to look at BA and Apple, as my partner Jordan typed in the box there. If you guys have any trades that you want me to take a look at, feel free to leave them in the comment box, and we'll definitely get to them. Breaking down trades all day today. If there's nothing after ACB and BA, I'm going to hop into some earnings trades. We're coming to the end of earnings season here. Earnings are our favorite thing to trade. There's so much edge there when you know what to look for. And I'm going to be breaking it down for you, showing you guys exactly what I look for when I look at earnings trades. Just so you get an idea for like how you can take that information and start applying it to your own trades. And of course, if you want to hop on a trade with me, feel free to. So looking at this again, we're probably going to see something similar where the IV is coming down, right? So yeah, we see IV gets crushed. RV moves in line with it. It actually was a lot higher than it for a while. So IV came down before, which is interesting to note. But here's something, right? Like, look, if you wanted to take a directional bet here, you're not overpaying, right? Unless you're buying the 30-day to expiration puts out of the money, you're not overpaying. So, like, look, if you have a directional bias of some sort, I don't condone, because I know that most times people think they have a directional bias. They're not really using tradable information. So they're looking at the news. They're looking at, they're looking at volatility for direction, which I'm not sure why, but the edge isn't really there. So I wouldn't personally say like, yeah, go out and just buy the calls unless you have a really strong reason for doing it. I prefer to take a lot more of like a systematic approach to trading, right? Because in the end of the day, as long as you can be confident that you have an edge, all you have to do now is manage your risk properly, and you will come out a winner in the end of the day, right? Like you can't afford a 60% drawdown. So you got to keep tight, play tight to the vest. And when you do that, you just need to make sure that you have that positive expected value. Pranav, when you go through the bronze course, like I think it's the second video, it'll talk about expected value. And this is actually the mindset that we go into every trade with, right? We want to go into trades and think to ourselves, am I supposed to come out a winner here? Right? Like if we take out my biases and, we just look at the numbers, like my risk reward and my probabilities of success, do I come out a winner in this situation on average? Do I have a real edge in the market? And if the answer is yes, and it meets your potential payoff, like threshold, like whatever you're satisfied with, take the trade. It's a good trade, right? You have a positive expected value, manage your risk properly, take the trade. It's a good position to be in. And if you do that over and over, you're now playing as if you're the casino. That's what's really meant by playing like the casino. It's knowing your edge and then structuring your trades to make sure that edge really shows itself before you lose your money. In the end of the day, guys, like take this in, nobody gets it right 100% of the time, right? Anyone claiming 90% hit rates is either running a type of strategy that has, a large blow up potential if they are wrong. And that's why they're right a lot more, because they just collect a little bit here and there. And then when it's like picking up pennies in front of a steamroller and, or they're lying. Because last year, for example, we placed over 2,000 trades. We basically did 100% on our book. So we did 100% on the money that we managed. And we had a win ratio of 57%, which is really high, actually. So we had a win ratio of 57%, and we ended up doing 100% on our portfolio. Like think about that for a second. Like you don't need to be winning 90% of the time to actually make money in this game. You just need to be in a position that you're making money. Like it doesn't need to be complicated. It doesn't need to sound nice, right? Like a lot of people think like a 56% win ratio doesn't sound nice. I want that 80. I want that 90. I always work on my win ratio. It's like, guys, take a step back. Ask yourself if you're making money first. If you're not making money, the question isn't How do I get my win ratio up? It's how the hell do I make money? Right? So, that's trading 101, Like if it makes money, it makes money, but we need to be critical about what we think about something making money. If we think that it's, if it just sounds like it makes money, or somebody told me it makes money, or I've done it once before and it makes money, that doesn't mean it's a winning strategy. It doesn't mean you have an edge, because in the end of the day, you could sit down at a blackjack table and win 10 hands in a row. It doesn't mean you have an edge in blackjack. You could get it right 15 times in a row on the roulette table. In the end of the day, you're still at a roulette table. Right? And I think that's one of the big traps that people fall into, is they start learning strategies for the roulette table. So they sit there, they'll learn things that make them feel like they're growing as a trader, but at the end of the day, they never turn that corner to positive edge. They're always still in that trap of like kind of chasing their tail, like always feeling like they're around the corner. And I was actually talking to my partner Jordan about this today, and it's super interesting. Like when I talk to a few people, and what I think it is like to learn the things that like are really, really forthcoming in the space, like the things that the new sort of winning traders are doing. It requires getting out of your comfort zone, right? A lot of people, like, it's easy to learn things that you're comfortable with because the concepts already make sense and you're just sort of like developing the concepts. But if we never stop to ask ourselves if these are concepts we should be learning in the first place, no matter how rational or how comfortable they may feel, how do you know if you're even walking in the right direction? Right? One thing that we were lucky enough is it only took us 2 years to get a nice slap in the face and someone say to us, guys, you're going in the wrong direction. And that person just happened to have enough influence in our lives that we actually listened to them, right? It helped that they were managing billions of dollars, because if they weren't, I probably would have done what most people do anyways and say, that's just an algo, or like, that's not for me. I'm just going to keep doing what I'm doing because it's comfortable and I've put in so much time already. But those moments, like Pranav, like I hope you're going to see by the end of that course, the difference between what we're trying to bring to the market here and what our traders are doing versus what's currently being pushed as trading education in the market. I think you're really going to like it. So to answer your question here about how to calculate an edge, how do I know your potential win-loss? So there's a couple things there. When you go into your brokerage, you can actually see your payoff. So you can actually see your payoff. So you can see like your maximum payouts, your maximum losses, how much you put in. So you can sort of get a sense of your risk to reward there. And then as for your probabilities of success, these are some things that, like, to calculate your actual probability of success, it requires like actually like back testing your strategies and stuff. So the things we do around earnings, you have about a 58% chance of success. So you have a positive edge and 58%, like positive expected value, because you have a positive 58%, and it's at least 1-to-1 risk to reward, if not higher, on each trade. And then every little strategy that we run, like every different structure, every different trade will have a slightly different risk to reward or probability of success. But what we do is we basically look at a bunch of factors that point us in a certain direction. And the more of those factors that line up, the more conviction we can have on the trade. So when we see the implied volatility higher than the realized, if we can understand why that's happening, we have a positive probability of success, right? Because we're basically buying cheap or selling expensive options. So I hope that helps. Like, you're not going to take that formula and necessarily directly apply it to your trades, but you are going to actually use that mentality when you think about your trades. I hope that makes sense. It's like conceptually, you want to be thinking in terms of expected value. And if you wanted to actually calculate your expected value for the trade, what you would really be doing is you would price out the option given what the market thinks. And it would be like, let's say $10 for the straddle. And then you would go into the terminal. We actually have an option pricing section. We can go through how to work that tomorrow on a live if you want. We do lives in the private group every day, so we can go over it in there. When we go into there, what you'll see is you would price it out using our volatility. And let's say the option in the market is $10 and our pricing is $8. Your expected value, if you were to sell that option, is $2. So it's the difference in price is actually your expected return, right? Assuming that our forecasts are accurate, which they're not always, right? It's a forecast, right? But they're right more often than they're wrong. And that's really what we're trading with, right? That edge, the fact that it's right more than it's wrong, at about a 6 out of 10 sort of ratio, that's sort of the edge that we're playing with as we go through this game. So guys, I'm going to break down a couple more trades here, right? Jordan was saying to take a look at BA. Let's see what's going on with BA. Okay. So implied vol is up. Stock price is at 142. Wow. That's crazy, man. IV30. Okay. Jordan, what's going on with this? Oh, we got some call skewed. We got a lot of retail traders in here. Hey, Viral, it's this is something that's available just to our, Jordan and I, my partner and I built this for ourselves to be able to visualize data. We have a project in the works though. We're giving a small group of people some access to this and some support from us. If you're interested in that, you can send me an email. You can reach, I'll type it into the comment box for here. If you send me an email, I'll get back to you and, I'll let you know what we're working on. It's a big project we're trying to build. Or you can reach me on Instagram at Predicting Alpha. So, you can hit me up there if you're interested in it. But basically what this tool does for me is this is my data visualizer for options. So, I subscribe to a bunch of data sources. I do a bunch of web scraping and I pull all this data together and visualize it here. So I can sort of look beyond just the price chart. A big trap that I think people fall into is they get caught up with the price action and everything, but they don't know what's driving it. And this is extremely important in the option space because if you can't price the asset, if you can't price out the option, you never know if you're trading with an edge or not. So this helps me look at data sort of beyond the chart. I look at regular volatility trading, right? Options are volatility-based products. If you understand how volatility works and what drives volatility, you understand what drives the option price, you can find real inefficiencies. So this is where our trades always start. We always start in the terminal looking for an inefficiency, and then we'll move outside the terminal to try and understand what we're seeing. And if we're able to find an inefficiency, understand why that inefficiency is there, the last step is to actually go into our brokerage and structure out a trade that lets us capture that inefficiency. So that's really the goal we're trying to build towards is finding a $5 bill for $3, right? And then we can buy that $5 bill for $3, hopefully sell it for $5. But we need to understand why that $5 bill is $3 right now. Because if we can't understand that, then there might be something we're missing and we should probably stay away from it. So for example, let's look at Boeing here, right? I'll try and do a quick breakdown on Boeing for you guys. So Boeing has implied volatility, about 10% higher than the realized volatility. So what this means is that the market thinks it's going to move 67% in the next year. We think it's going to move 59. And if we pull out our calculator, we can actually break that down to what it's going to move on a day-to-day basis. All we have to do is take the current implied volatility in the market, so 67.84, and then we need to divide it by 16. It's square root of the time basically. And what we get is 4.24. So what this tells me is that the market is expecting Boeing to move 4.24% on average for the next few days at least, up or down, right? But the size of the move the market is expecting is 4.24%. But when I do my own, calculation here with my implied volatility, I get a number of 3.69. So the market thinks it's going to move 4.24. I think it's going to move 3.69. So think about it. The market thinks it's going to move like this. I think it's going to move like this. So what this tells me, right? Remember, volatility is correlated with the price of the options. So important to understand that. Option price is driven by implied volatility of the future. Knowing that the market thinks there's going to be more volatility than what I think there's going to be, what this tells me is that the options are going to be more expensive than what I think they should be priced at. So what I can do is I can go out and structure a trade that lets me sell those options, collect an inflated premium, and then hopefully not have to pay out as much down the road when people go to either exercise those options or have to close out the position. And what we call this is a statistical edge. So we actually have an actual edge in the market because we're selling an overvalued asset. But before we can go ahead and actually place this trade, we need to go online and actually do some research to go, why is this asset overpriced, right? Because if we can't understand why it's overpriced, how do we know that it's not insider trading, right? One thing that I looked at here, I'll show you guys quickly, MYOK, right? This is one that I was looking at, a week and a half ago or whenever it was. And if you look here, the realized volatility was going down. So the stock was actually starting to move less and less, but the market was bidding up the calls. 10,000 calls were traded on that Friday, and then they came out on the Monday saying they passed their trials. The stock jumped 60%. If I had just been looking at this from a data perspective, I would have seen this and gone, I'm going to sell these options because they're so expensive. I'm going to go in there. I'm going to sell these. It's going to be great. I'm going to collect a huge premium, money in the bank, right? I'm retiring for the weekend. I'm going to go buy a nice bottle of wine, a nice bottle of whiskey. I'm going to sit back, but I can't do that because this ended up being what I considered to be insider trading. The way that I caught it was seeing that the implied volatility kept rising even as the realized went down. And when I went to look at the stock online, I went to do my external research. What I saw was that I couldn't understand why this was happening. There was no news coming out that was driving up the price. Like between when they had said they were in the trial, when they had said the average time they were going to get the news, no other news had come out. So I'm sitting there going, we already know what's going to happen. We know the odds of success. Nothing has changed between now and the news that came out a month ago. But the implied volatility is skyrocketing. If I had done more research, I should have actually placed a trade on there being insider information here. Didn't have enough data, moved on to another trade. But this is the type of stuff that makes me think, it reminds me of the importance of doing research outside of the data. The data is where we find our edge. It's where we actually go in and we find that little golden nugget that we can actually capitalize on. But then we need to go outside of the terminal, outside of wherever you're gathering your data, and you need to actually understand it, right? So I'm going to go look up some BA news. It doesn't need to be a crazy in-depth thing. You just need to understand what's going on, right? So I haven't looked at this yet, guys, so bear with me as I go through this. If you guys know what's going on with BA, let me know. Reality of working. So some jobs are under threat, hundreds of jobs, okay. They're going to move ahead with job cuts. Cool. Okay, so none of this seems like really new news to me. We all sort of saw this stuff coming. What's going on StockTwits? Let's have a look at BA. I always come to StockTwits to take a look because in the end of the day, you got to remember this, guys. Whenever we're trading, there's actually somebody on the other side of our trade. There's another person there. If you break down what a market is, it's a bunch of microtransactions of you and another person. Right? If, there's a chance that you and I have traded on the other side of trades before, or been on the same side and trading against other people, right? Every single transaction in the market takes place between you and another person. So a big question that you want to ask yourself, and what we're really always trying to do is be on the right side of the trade. So who we're trading against, who we think is on the other side of our trade, is an extremely important thing to keep in mind. Because if you can understand who is on the other side of your trade, you can understand their reasoning for being there, right? There's really only a few groups of people that it could be. It could be retail traders, right? It could be retail traders. It could be funds. It could be sophisticated traders, or it could be market makers. And what we're basically like in the ideal world, we would always trade against the retail traders and we would never trade against the sophisticated trader. What makes someone a sophisticated trader is they have access to good information. They know more than we do. We actually want to be considered the sophisticated trader whenever we're getting into a position. And what makes someone a retail trader? StockTwits, Wall Street Bets. Basically, what we would consider, not the money that we want to be, right? People, who are using old school methods, or don't have access to the same level of information as us, right? That we have an edge over. And whenever I have a retail trader on the other side of my trade, I know that there's a good chance that I have the statistical edge. So let's take a look at the sentiment here. We're gonna see some bullish sentiment. Yeah, so 80% bullish. People think Boeing's gonna keep going to the moon. Message volume, not that high. So people are sort of tapering off a little bit about how much they're looking at this. But everyone that is looking at it, it seems to be like they're pretty bullish. We got a few doomsday callers here. We got some interesting stuff going on, guys. Some people are really, it's sort of all over the place. I'm not sure why Jordan wanted me to take a look at this. It doesn't seem like there's much news. Based on what I'm seeing, it's a good short, right? Short the volatility here. If you want, you have all this skew going on. So if you have a directional bias on Boeing, you can structure a 1-3-2 fly to take advantage of the skew. right? So you could structure it to the call side or to the put side, whether you're bullish or bearish. That's not actually a bad idea. If you have a bias, you can structure probably a very cheap trade here, right? You could probably get like 7-1, 8-1 risk to reward, maybe even higher. So, consider that, guys. And then we want to take a look at ACB. So, guys, this was a trade that we put on the other day. It was a really, really sick trade. We ended up cashing out huge on it. The implied volatility was absolutely nuts. It was up at 500 back when we traded it, and we closed out for a 40% gain. We had a $10,000 position on. And if you want, I made a video about it, breaking down why I took that trade. It's on our page. You can go see it. It's just called My $10,000 Bet on ACB. Leave a comment on there. Let me know your thoughts. If you have any questions about how we structured out that trade, more than happy to help you with that. But ACB, if you look, implied volatility is still really high, but that's not a surprise for this stock. The reason it's not a surprise is, especially, let's take a look. If we go here, all right, let's take a look. ACB, what we're going to see is probably, tons of watchers, right? Probably super bullish. Actually, I don't know, probably 50-50. 74% bullish, right? People are really picking up on it. Message volumes back at all-time highs. 16,500 messages being sent about this thing. Absolutely crazy. ACB holding till 100. Like, this is who we want to be trading against, guys. Like, come on, guys. This is who we want to be trading against. So yeah, still probably a really good opportunity to sell options. They're implying a huge move, right? They came out with news today about their expansion into the US. And even then, it didn't move enough to hit our stops. We ended up still making money on our short position, our short volatility position, because when you get a stock like this that just gets so much momentum behind it from the retail crowd, they're not price sensitive. So whether the option costs, $10 or $5, they don't care. Just give me the option. So we want to be trading against these people. It's always a good time when we're trading against them. This is such a good meme. So guys, if you're still looking at ACB, if you're in a position on it, it's probably not bad to still be holding it. It's back at the $15 mark. If we still had our position on today, we closed it yesterday, we would have been up probably like 70% on this thing. But we were happy with the gains we made. We got out of the position. And guys, it's still looking like a pretty juicy trade. Okay, so that's going to wrap it up for this session, guys. It's 11. I try to keep these to a half hour because I want to keep consistent. I want to do these every morning. If you haven't already subscribed, make sure to subscribe. And if you have a friend that trades options, this is honestly the type of information that people need to be trading on. And come the next 5 to 10 years, everybody will be using information of this nature to be placing their trades. We're not talking about algos, nothing automated, right? There's a lot of discretionary stuff left in structuring these trades and researching these. But by applying some simple statistics and some mathematics to our trades, we're able to find real edges with real golden opportunities, and we're able to actually make a lot of money trading. It's the best edge available to the retail market. So, if you have a friend that trades options, please share this with them. I'd be happy to, break down their trades with them, give them some insight into our world of trading. And until next time, guys, take it easy. We'll see you tomorrow.